year for Southern Company. We had total shareholder return last year of about 27%, and well exceeding most other type of investments that you could have made. The utility average had a great year at 19%. The S&P 500 was about 2%, but you can see Southern clearly outperformed them. That's our one-year performance, but if you look over 10 years, Southern Company has continued a track record of just stellar performance. If you look at this kind of compound annual return that is represented, Southern Company's about 11.4% compound annual return over the last decade. The utility average would be about 8%. The S&P 500 would be about 3%. So we've done awfully well for a long period of time. And when we think about total shareholder return, we want to be very clear, and this will become very important later when I talk a little bit about national energy policy and the fiscal issues that are related to that, that the lion's share of our returns to shareholders during this spectacular decade that we've been on, the lion's share of it, 57%, has come from dividends. So let's always remember how important dividends are to the success of our company and you as shareholders. Now, of course, during this time frame, and recall, over the last decade, the United States has seen certainly its share of challenges in terms of the economy and all kinds of worldwide events that impacts kind of the capital markets. During that time, Southern Company has had capital gains, price appreciation of 43%. If you look particularly at last year, we set 24 all-time highs during that year, starting the year at a price a little bit above $38 and ending the year well over $46 a share. And think about kind of the last half of this year, kind of in the August forward time frame, where Southern really performed well. If you recall last year's economic environment, that's where we started seeing questions about potential meltdowns in Europe, continued malaise in the United States. And when investors, thinking about value as a function of risk and return, saw that risk was ever more important in today's environment, they rushed to buy shares of Southern Company. And you can see how well we did. But it isn't just about the stock price. I mentioned before that Southern Company produces the lion's share of its return with dividends. We're one of a handful of companies that has been able to increase its dividends now 11 years in a row. And it isn't just over the last decade or the last 11 years. Really, since 1948, 48 marks the year in which Southern Company was formed, the most recent version of our holding company structures. Through the worst times in America, various recessions, oil embargoes, everything else, we remain committed to the dividend. This company has never cut its dividend. And so as a matter of corporate principle, representing you, our shareholders, and providing the right kind of financial philosophy to carry this company forward into the future, we remain resolute in our support of the dividend. Now, we could say 1 year, we could say 10 years, but if you look at almost any time frame, 5 years, 30 years, Southern Company has been a wonderful investment to own. Total shareholder return, capital appreciation plus dividends. You can see that versus the S&P 500 or the other utilities you could have invested in, this has been a dynamite place to be in ownership. So that's the normal stuff you see. I think you'll find this interesting. The number of companies that has been able to demonstrate this kind of performance are really an elite group. And so what we wanted to do was just kind of take different cuts of how unique our performance has been over the last decade, looking at dividends, looking at risk profile, and finally looking at the total return posture, and compare that to who our peers may be in the S&P 500. So I hope you find this interesting. First, the dividend. We start with all of the S&P 500 companies, and those of you that read the disclosure statement can read this perfectly. But what we do is we start with the 500 companies, then we start making cuts. So here's the first cut. We eliminated companies in the S&P 500 that either, over the last decade, don't pay a dividend or have cut their dividend. So all that remains is 217 out of the 500. These are companies that grew their dividend over the past decade. We make another cut to say how many companies out of those 500 grew their dividend every year. You can see this is a rather exclusive club. And if you look at how many grew their dividend as much as Southern, it's even more exclusive. And then you say, how many companies, because some of these companies have very small dividends, how many companies have as part of their total shareholder proposal to investors, have a dividend yield of 4% or more, where it's really important in terms of the TSR profile. And there's only 3, Avon, AT&T, and Southern Company. So that's the dividend story. Let's go to risk. Start with the same 500 companies. Now let's look at bond ratings. Bond ratings are a way of measuring the safety of your debt securities. It's a good measure of risk in corporate America. And recall that there are several strata of bond ratings. The highest level would be AAA, then it goes to AA, then single A, which is where Southern Company is, then triple B. Below triple B, so it'd be double B plus or below, is what they call non-investment grade or junk bonds. Okay, so you got to be triple B minus or better to be investment grade. Only about half of the S&P 500 have credit ratings triple B plus or better. When you look at Southern Company's rating, single A, only about 20% or 105 companies have that kind of bond rating. And it isn't just about bond ratings. That kind of covers how people evaluate the safety of your debt. Let's think about the safety or the volatility of your equity return. There is a statistic called beta. So let me explain that. If you own every share in the S&P 500, your beta, your measure of systematic risk, is equal to 1. It's like an index. So if you own every stock in the market, it's a beta of 1. Southern Company has a beta of 0.55. During this time, it had the second lowest level of equity volatility in the S&P 500. And the only one that had a lower level of risk, as measured by volatility here, was Hormel Foods, the home of Spam. So now let's go to return. Start with the same 500 companies.